Back in 2010, when Nick Clegg was asked about nuclear power, he said it was pointless because it wouldn't be ready until 2022. As it happened, 2022 came and went, with an unprecedented surge in global energy prices. Although this was ironic bad luck, the UK was uniquely unprepared for an energy crisis, with its cold, drafty homes and reliance on gas and lack of investment in energy. Nick Clegg was right about one thing. In 2022, he wasn't involved in politics anymore. It was now someone else's problem. The energy crisis highlighted many long-term failures. Back in 2013, the government of Cameron and Osborne pledged to cut the green crap and removed environmental levies. This moved wrecked the UK's insulation programme, cutting insulation rates by 90% and adding £2.5 billion to household energy bills. The UK has the worst insulated homes in Europe, worse than sunny Spain and Mediterranean Italy. The UK has the highest share of houses built before the war. Single glazed windows still adorn listed buildings. Downton Abbey may look good, but don't ask about the heating bills. In 2022, the UK spent £100 billion on energy imports, and the government spent £37 billion on subsidising bills. But in the 2010s, despite interest rates close to zero, the idea of investing in insulation or renewable energy sources was a very low priority for a government fixated on austerity. Now, the UK is actually lucky to have many natural resources: oil, natural gas, and a temperate climate with plenty of rain. But despite one of the highest rainfalls in Europe, the UK can't manage to run out of water. In 2022 and 2023, large parts of the country had a hosepipe ban and reservoirs ran perilously low. The National Infrastructure Commission warned that by 2050, the UK could be 4 billion litres of water short per day. How can such a wet country run out of water? In the Victorian age, extensive reservoirs, sewers and water systems were all built to meet the growing demands of cities. But the water privatisation of the late 1980s fractured this holistic approach to water management. The UK's last completed reservoir was in Derbyshire in 1992. In the late 80s, privatised water companies were sold with zero debt. But over the next 3 decades, the new companies prioritised short-term returns, dividends to shareholders, and despite an £80 billion increase in debt, only very few reservoirs have been planned, let alone built. Overall, the UK's privatisation programme of the 80s and 90s raised in the region of £70 billion, which the government largely used to fund current spending and tax cuts. There was no long-term plan to invest in improving creaking Victorian infrastructure. In the 1980s, public sector investment fell and never really recovered. Even the low current levels of public investment include £40 billion of student loans. Whilst other European countries have invested in high-speed rail, the UK lags behind. The growing population has placed a great strain on road and rail infrastructure. Now, one rare long-term plan was HS2, a link from London to Birmingham and then up to the north. But with depressing predictability, it ran over budget as resources were diverted to provide cosmetic improvements for constituencies in its path. In the event, the project was partially cancelled, leaving a rump just to Birmingham, but no solution to the long-term predicted travel demand in the north. In a typical act of political short-sightedness, after cancelling the project, the Prime Minister Rishi Sunak ordered the sale of any land to prevent a future government reversing the decision. It's been a recurring theme of the past few decades. Sell off the family silver for a quick buck, whilst problems slowly but remorselessly build up. A similar lack of planning has left prisons full, prisoners released early, courts delayed and the justice system creaking at the seams. But if you think that is bad, maybe we haven't seen anything yet. The forecasts for future tax and spending are pretty grim. The latest OBR forecast is that on current policy, government debt is forecast to soar. Even without any more external shocks, debt is predicted to reach levels not seen since a major war. Now, if this debt was being used to fund investment, it would be less worrying, but it reflects the growing cost of an ageing population, rising demand for healthcare, and ever higher spending on pensions. Pension spending is set to soar. There was never a state pension fund. When the recent government tried to save a tiny fraction of $1.5 billion by cutting winter fuel allowance for the relatively better off pensioners, there was a huge political backlash. It's hard to promote long-term solutions to social care, pensions and healthcare when voters expect to maintain the kind of spending and tax levels the recent economy is struggling to support. Now, in this regard, the UK is far from unique. In fact, the pension crunch will probably be worse in countries like Italy and France. Now, in the post-war period, the UK was still an economic powerhouse. In 1950, the UK was the world's second largest producer of cars and the world's biggest exporter. But resting on its laurels, it failed to keep up. UK productivity lagged behind its rivals, and within 2 decades, the car industry was on its knees, hobbled by strikes, poor management, and a lack of investment. British cars just didn't work very well. By the 1970s, the UK was undergoing an economic crisis, high inflation, strikes, and humiliatingly, an IMF bailout. It was against this backdrop that the discovery of North Sea oil was incredibly well timed. The Labour Prime Minister James Callaghan declared that oil was God's gift to the British economy. But if oil was God's gift from above, how was it used? Whilst Norway's government kept 50% ownership and high tax, they've been able to build a sovereign wealth fund of $1 trillion, all diversified away from fossil fuels. There will be no pension crisis in Norway. Under Thatcher, the UK prioritised tax cuts. Now, you could argue that the UK's highest rate at 83% was damaging incentives to work, and trade unions did need reforms. But whilst that might have been true, the UK also needed investment in many areas from housing to transport and energy. But the 1980s was a decade where the government wished to leave decisions to market forces. Now, there was a minor revival in the UK car industry thanks to Japanese investment. But if you take housing, Thatcher's signature policy was selling off social housing to tenants. In 1979, social housing was 30% of all households. But over the next decade, 1.6 million was sold off and not replaced despite a booming population. The proceeds from the sales could have been used to fund new housing, but it wasn't. Now, the policy was very popular with those who bought at a large discount, but it stored up problems for the future. In 1980, house prices were 3 times income. Today they are closer to 8 times income. Housing has become a luxury good, dependent on parental wealth. The UK has fallen behind in house building. Leaving it to the private sector, home builders have been in no rush to increase supply and reduce their profit margins. 40% of council homes sold under right to buy are now let in the private sector. Often councils have to pay these private landlords to house the homeless, priced out by market rents. Rising private rents also mean the government have a huge housing benefit bill, subsidising private landlords for housing they used to own. Now, despite its limitations and underfunding, the NHS is rightly regarded for providing free healthcare at the point of use. In fact, bringing together all the disparate private doctors and hospitals in 1947 was an example of long-term planning that has paid dividends. But now a service close to breaking point is also subject to the short-term disease. When resources are spread thinly, and with 7 million on waiting lists, doctors only get to see acute cases, and the solution is to patch up the symptoms and send the patients home. What is missing is a long-term solution to deal with rising economic inactivity and poor health. In recent years, we've seen rising long-term sickness across all age groups, and it's not just due to COVID. The UK healthcare system is designed to treat people who come through the doors. Preventative treatment is largely off the agenda. Now, there are innumerable ways to improve the nation's health: more exercise, reducing the cost of healthy food, advertising for junk food, insecure work. But efforts to improve health, like active travel and taxing junk food, tend to get drawn into media culture wars and quietly dropped. Professor John Deanfield claims a parallel preventative health service could reduce ill health by 33% and potentially increase GDP by £320 billion over 20 years. That's a kind of long-term strategy the UK needs. In the past decade, net migration caused over 60% of the growth in the population. Now, whilst largely working age, net migration tends to improve public finances, which is a boon to chancellors trying to balance the budget. But despite this net improvement, it's not been translated into improved public services or more housing, making the public sceptical about the supposed economic benefits of migration. If a population grows, you do need to invest in more long-term services. But it's not just the government, which is subject to short-termism. Private businesses too are struggling to invest. Firstly, UK companies are more influenced by shareholders and the stock market rather than investors who look to the long term. A trend worsened by the recent explosion in executive pay linked to equity and stock options. With a strong profit incentive, there is a temptation for CEOs to cut back on something like research and development to boost profit and share prices in the short term to get a bigger paycheck. Whatever the reason, the UK clearly has a low level of research and development, something which has held back long-term growth. Now, UK business argue it is not so much short-termism on their part, but frequent policy changes and self-inflicted crises which make it more difficult to invest. Certainly the uncertainties of Brexit was a major factor which derailed the economy in recent years. This video looks at why Brexit was damaging for the UK in the long term, creating problems rather than solving.